Yeah, I'm just at Scottsdale at Black Rock Coffee.
Good stuff. Emmett, good to see you. Amber, did you change your first name?
Oh, I'm logged in on my son's account. That's hilarious.
Oh, awesome. All right, folks. Well, we're going to go ahead and get started. I'll hit record. Appreciate you being patient. A little rusty after we took last week off. Excellent. Welcome back, folks, to another Rev Real Estate Live. My name is Dallin Schultz. I am the host of this weekly webinar. At Rev, we focus on multifamily investments, and we're very passionate about educating others in the space. And so what we're going to be talking about today is one of the most common business plans that we're involved in and that you'll see across the board with those getting into apartment investing, and that's the value add business play. So on a whiteboard behind me here in just a minute, we'll actually break down the 4 different types of investment types that you'll see within real estate. We'll talk a little bit about the differences. And then I'm actually going to take you through a case study. I'm going to take you through a deal that we purchased, it was probably 2 years ago. And in 14 months, we turned it around and sold it and actually did very well on it. So I was going to walk you through that. So during this process, if you have any questions along the way, please just throw them into the chat box, and my team is monitoring that as well. Or if you're tuning in via live, throw those questions in to the chat box, and my team will relay those to me. Especially if a question comes up during conversation of what we're talking about, please ask it, because we're going to be moving through some of this stuff. So I'd rather address it, touch on it at that point so that we can keep moving. If it's something that I feel like will take us into the weeds a little too deep, then I'll just say that, and happy to follow up with you specifically regarding that question after this call. So we are being recorded. We are going live. So again, appreciate you all being here, and let's jump into it. So behind me here, okay, we have 4 types of real estate investments. And so we're going to touch on this briefly, just take a few minutes here. So your first one is core. Then you have your core plus. Then you have your value add. I'm going to have to do squats. This isn't going to be fun. I did legs yesterday. Opportunistic. Okay. So you have your core plus, your value add, and your opportunistic. So what your core is, I don't know if Fred's going to come up good. So your core tends to be the least. Can you guys see that red okay on the board? Or is it too light? Bruce, you're shaking your head. Okay, Emmett, can you see that okay? The red? Okay. So your core tends to be some of your less risky type of investments. An example of a good core investment opportunity could be a Walgreens, for example. These can also be called or referred to as triple net leases. And so with that, these people might be in a lease for 30 years. And it's a big company like Walgreens, CVS. And so the investors will purchase these properties, lease it back to the companies, or the companies will lease it from them at a much lower return. You might expect anywhere from 5 to 7%, 5 to 6%, but you don't need to do anything as the investor, because the way these leases are set up, it's very often to be triple net, meaning whoever's leasing that property is responsible for everything, for all the repairs, maintenance. And so it's probably the most passive investment that you can get involved in as a real estate investor. However, it's again, one of the least riskies, but may not get you to where you want to be with your financial goals. So just something to keep in mind. Then you have your core plus. Your core plus assets. These are projects that were probably built in the last 15 years or so. Last 15 years. So this could be an apartment building that was built in 2005, 2006, 2008. So properties that are still considered newer, that still require some work and some management, but may not be as hands-on as a value add play, which we'll touch on in a little bit. So this is your light, I'd say light risk, light to moderate. So you're still going to have to manage the asset, but it's going to be light management. You might be able to get away with a call twice a month, maybe once a month, if you have the right management team in place. So you attract good clientele, good tenants, and they take care of the property. So it's not quite as hands off as your core, but it's not quite as intensive as maybe your value add. So for example, this core plus, we just closed on a property last Monday, right before Christmas, 114 units in Houston, built in, was that 2013? I think it was 2013. So that one is a fairly recent deal. It was built not too long ago, and we're attracting a certain type of clientele. Now, fortunately for us, there was very poor management in place. So there's going to be some heavy management up front just to get the occupancy back up. But overall, there's not any major deferred maintenance. There's not any major repairs. It's a great looking asset. So that would be an example of a core plus. Your value add, let me go back here to core plus. When you talk about classes of properties, you got your A, B, and C class, A being your luxury high rises, B being a lot of your garden style. So you got A, B, C, and there's actually even D classes, which we joke about, stand for do not buy. But there's some people that do very well with those asset classes and they enjoy them, but they have the right team, systems, and processes to do it. So it's not that and that's down here, right? Opportunistic are going to be your D properties. So your value add, these are your C class properties. These are properties that might have been built in the 60s, 70s, 80s, 90s that are going to experience little to no cash flow upfront, because a lot of the work is going into forcing that appreciation. So they may not start cash flowing. We'll say no cash flow for, we'll say 3 years. Just because you're completely transitioning this property. You might be taking it from a C class property and doing B class finishes in it. And that stuff takes time. It takes time to get your occupancy up, takes time to turn those units. So your value add would be, I would consider more to moderate to high risk as an investor. Moderate to high. And like I said, these are your C class properties. So where we have actually been, we've actually have experience in all three of these, but we're leaning more towards these core plus currently with our company. So you're opportunistic. These are your extremely distressed properties. These are properties that might be operating at 50% occupancy, or maybe you need to kick everyone out and completely redo these properties. Development could also fall under this as well, because there is absolutely no cash flow in these deals, and it's very management intensive, a lot of development, a lot of experience. So you got to get that involved in these opportunistic deals. However, the flip side of that is that they often do very, very, very well if that business plan is carried out effectively. So it's not for everyone, and an opportunistic it could be a good strategy if it aligns with your goals as an investor. So this is what you got. You got your core. These are they're your least risky investments. Think of your Walgreens, right? You buy a Walgreens and Walgreens leases it back from you and they take care of everything. And then you have your core plus. These are your 10 to 15-year-old apartment buildings. Then you have your value add stuff built in the late 80s, 90s. Then your opportunistic, which are your extremely distressed or development opportunities. So just wanted to touch on the differences of those briefly. But before we move into our case study on a deal that we went through at the start of this year, any questions about any of these topics here? I don't see anything in the chat box, so we're gonna keep moving. Excellent. And keep in mind, if you're newer to real estate investing, these are things that you need to be aware of. What types of deals are your operators that you're partnering with? Are they going after? Are they going after the opportunistic, value add, core plus core, and what are the differences between them? So definitely look these up, do some Googling on them, and you'll be able to find plenty of information on it. Okay, so now we're transitioning. We're going to share a little bit of a deal, walk you through a deal that we purchased in a small community just south of Phoenix, in a small town called Coolidge. Okay, is that coming through good? Okay. So this was an opportunity that we, a few years back, we were looking for a lot of these value add deals as a team. And it was extremely difficult. We didn't feel like we were gaining much traction. So my partner at the time was a contractor, and we said, let's explore development. Let's look into development, because there's definitely a need for housing, especially in Arizona. So we just made that little pivot, and within a few days, we found this opportunity that had actually been on market for over a year. But since we weren't looking for it, we didn't recognize it. So what the opportunity was, if you look at this red box here, this is what was listed. So these are 4 duplexes, and this was smaller than what we were wanting. But what interested us was this vacant lot of land right next to it. That was being sold along with the 8 units. So we started doing some due diligence and exploring, like, what could we build on that acre of land? And as we looked into it, we realized that if we got it rezoned, we could build an additional 30 units on that piece of land. So it was enough for us to want to explore it further. So we went down, we met the broker down there on site. And when we showed up, right across the street here in blue was a brand new assisted living facility that was just getting wrapped up. So we said, okay, there's already development going on in this town. It's a nice new facility, and that gave us promising hope with working with the city. So while we were there, the broker was telling us a little bit about this property, and he said the seller actually owned this piece of land in blue just west of the subject property as well, that's zoned for commercial. And we said, okay, is he interested in selling that as well? And he said he actually might be. So what we did was we actually purchased this as a package. We purchased the 8 units with the vacant acre lot, along with, this ended up being in total about 2.5 acres. And what we decided to do was partner with another person to develop an RV and a self-storage facility on this commercial lot. Now, this highway here, if you look just to the west, Arizona Boulevard, this is the main highway cutting through this town. You can't drive through this town without being on this highway. And we have all this highway frontage here for the storage. So it was really set up in a good spot, and we were excited, looking forward to moving forward with it. So we got under contract, we purchased it, we closed on it, and we got this land entitled, meaning this land was already zoned for multifamily, but it didn't have any of the approvals in place. So we had to work with the city, we had to work with the civil engineer, we got some plans drawn up, and we got everything approved. We got everything in place. And then we ended up selling it because we had an opportunity, an offer come in to purchase it for more than twice than what we paid for it 14 months earlier. However, we did that was just for the multifamily. We kept the commercial, which we're not talking about on this call, but it was a great deal. And what we loved about this opportunity is that these 8 units here covered the cost of the land. And that was important to us because as we were transitioning into development, we knew there was going to be a learning curve. We knew that there was going to be a lot to learn and to go through. And so not having to front all that cost and having those 8 units be able to cover that expense allowed us to be able to get our toes wet in the development space. So here are some pictures that we took of the property. This was built in early 80s and had some light remodeling done on the outside. A lot of the units weren't upgraded. I'd say they were probably pretty classic from the 80s. Rents were about $600 to $650 a month, I believe. And these were 2-bed, 1-bath units. This is another thing that we look for when we look at properties too, is what kind of cars are people driving? And I know that doesn't tell the whole story, but you have a bunch of cars that are sitting on cinder blocks. Are they beat up? Are they crashed? Or are they nice quality working commuting cars? And that's what we looked for. So you got the Honda CR-V, the Mercedes, the Charger. These are some of the things that we look for when we look at these value add type of opportunities. And the cool thing about this project was this was actually a combination of value add and opportunistic with the development. So it gave us a chance to dabble in both of those areas. So this is not what they look like when we purchased them. This was one of our remodels, and we put in, I'd say on average, about 20,000 into each one of these units. And that got us new cabinets, granite countertops, appliances, paint, new flooring. We refinished a bathtub, new bath vanities, toilets. I mean, they looked completely different. And I'm not going to get into it. We actually had one apartment here that we nicknamed actually, never mind. I'm not even going to go there. It was bad. It was really bad to say the least. And so it's what I love about value add, and I think why a lot of operators enjoy this space is because you are taking a very tired and worn out property and making it look new again. And that can be very rewarding. It can be very enjoyable because you're completely transforming this property. And along with that, you're transforming your tenant base. You're attracting different types of tenants so you can truly go in and improve communities. And I think that aspect is what draws a lot of people to this area of real estate, is because you can truly make an impact and it's rewarding. And we first thing we did when we got in, we got rid of the troubled tenants, and we had other people thanking us for doing that. So after these remodels, we got $400 or $500 rent bumps on these. One of these units, I think, was renting for $650 when we purchased it. And then by the time we sold this property, we had it rented for $1,050 to $1,100. So we're right around that $400 or $500 rent bump on these properties, that's some serious value add. And it was really exciting to see. So we ended up turning about 50% of these units before we sold it, leaving some meat on the bone for the next buyer to come in and to keep working on the business plan. But at least we had a proven concept. We said, hey, look what we did with these units. This is what we're getting for rent. So we had that proven concept so they could confidently go in and complete the project. So this was part of the development that we worked on. So as you can see on the left side, these are the 4 duplexes. And on this acre of land, this was the plan we had drawn up for a 30 unit. This was a 3-story garden style, 1 bed, 1 bath units. And they were all about, I think, 670 square feet or so. So that's how the layout was going to be. This driveway here was going to connect to the other one, so it would create a U shape. And this is what the inside would look like. Very simple, open concept. And this is what we had in place prior to selling. That's what the finished rendition was going to look like. So we were going to match the existing property to match it as far as paint and everything looks. Okay, so let's get into some numbers. This is the fun part here. So the purchase price, we've purchased the 8 units with the acre of land for $645,000. That's, looking back, that was an absolute steal. I'd be surprised if you can find anything like that in Arizona right now. And renovation costs, we put in about $100,000. Now that was for the units that we remodeled and for some of the initial engineering and getting application fees and things like that. So all in, we were roughly about $745,000. So for this property, we got a $450,000 loan, which led us to needing to bring in $295,000 in equity. So a little over $200,000 of that equity was with a single investor. This was not a syndication. This was a joint venture that we did. And then the rest of it was our own capital. So the combined rents on purchase were roughly $5,200 a month. Post renovation, we were at about $8,000 a month. So really able to boost that value add. So the property was cash flowing great, but like I said, the opportunity came up that we couldn't turn down. Okay, so 14 months later, we were getting ready to build this out. We had the plans approved, we were ready to go. And we said, hey, do we spend the next 2 years building this out? Or do we sell it as a package to somebody else? And so while we were engaging our contractors and working with them to work on the budgets, we also decided to take it to market just to see what would happen. And within a month or so, we had an offer for 1.55. And that included the 8 units, the land, and everything that we put into it. So after we paid closing costs, that was about $90,000. We paid off the loan. It was an interest-only loan that we were paying. And then we had return the capital, the equity that we brought in. So some of that came back to us, and a good portion of it went to our other investor. So our total profit on this deal in 14 months was over $700,000. And here's one of the posts that we put out after we sold it. So that single investor that came on, at Rev, we try to target doubling investors' returns in 3 to 5 years. Those are the types of projects that we look for. In this project, if you look at that 2.3x equity multiple, we more than doubled his investment in 14 months. This deal is not typical. This deal is not common. This was what I would consider a home run deal, but it was also a very small deal. So I think that's important to mention, is that when you're getting started in real estate or even in apartments, it doesn't need to be a massive 100, 200, 300 unit property. You can do very, very well with smaller deals with the right partnerships. And fortunately for us, like I said, if this was 8 units on its own, we wouldn't have gone after it. It didn't interest us, but the development piece did. So between the value add, we had a C-class property that we improved the units, we forced the appreciation, and we had the opportunistic ability through the development. We were really able to capitalize on these 2 strategies and the market as well. By all means, like we did our part, but the market played a huge role in this as well. But that's what we were able to generate these types of returns, and it worked out to be around a 90% average annual return for our investors. So very exciting project that we were able to get additional experience in both the value add and opportunistic space. But that's really what you do with value add real estate. You go into a property, you renovate it, you can increase rents, you can charge pet rent, you can put in more effective management in place. Because at the end of the day, I know we've talked about this before. I'll bring it back up here. So we've talked about how to value apartments. Values are a business. You are buying a business. And to determine that value, you take your net operating income, or your NOI, and you divide it by the cap rate. Now, the cap rate, that's what the market determines. The NOI, the net operating income, that's your income or your rents minus your expenses, gives you your net operating income. This is what we have control over as real estate investors. There, stop sharing so it's a little bit bigger for you. This NOI is what we have control over. So with these value add deals, your NOI, like I said, it's your income. And this is broken down in more detail, but I'm keeping it simple for you. Minus your expenses gives you your NOI. What you do is you go in here and you increase income through renovations, through rent, through pet rent. Some of these properties will have storage units, so you can charge for storage. In Arizona, covered parking is really big, and so you could charge for covered parking. There might be garages in some colder states, so you can charge some of that extra income to boost it. And then with your expenses, if you get more effective management in place, when you get more effective management in place, then you decrease expenses. So what happens is that you ultimately increase your NOI. And that is a value add play. You're forcing the appreciation. And that's why we focus on commercial real estate and apartments specifically at Rev, is because there's still some aspect of control. We don't have any control of the market. We don't have any control of that. And that's an important thing to understand. So apartments have proven to be the most recession resilient, but not the recession proof asset class to invest in. And it comes down to this control and the fact that apartments are a basic human need. And another good way to increase your income as well and decrease expenses simultaneously, I guess it's more decrease your expenses. Some of these older properties, the landlords paid for all the utilities. They paid for the water, they paid for the electric, and it depends how they're metered. For example, that deal that I shared with you, we were covering all the water for the tenants and trash. And what we did was we actually billed that back to the tenants because they're the ones using it. And so what that is called is RUBS. It's a ratio utility billing system. And we were able to implement that. So tenants were, that expense of utilities that we were paying was offset probably by 80% just because of the tenants, us billing the tenants back. So that's a huge value add. So when you're looking at these deals, when you're looking at these apartment deals, those are questions, those are things you want to look at. Is there a RUBS in place? Are rents $300-400 below market? Is the occupancy very low, but it's in a nice area? What are the comp properties renting for? Are they 94% occupied and yours is at 80%? If that's the case, that's an awesome value add indicator, because then you can go in, put in effective management and get that property up. So in a nutshell, that's really what value add investing is and the business plan is. And I'll be honest, that's all I've got for today. There wasn't too much that I wanted to dive into in regards to this value add play, but I wanted to show the 4 different types of investment. You got your core plus, value add, and opportunistic, then also take you through that simple case study of the deal that we closed on. That was actually back in March of this past year. But with that being said, happy to answer any questions or any comments that anybody has regarding what we talked about today. Thanks, Randy. Appreciate that. Bruce, if you don't mind, I'm going to pick on you a little bit if you're available.
What?
Bruce is the king of value add and opportunistic properties. So, Bruce, what have been some experiences you've had as you've dived into some of these either motel conversions or some of these heavy lift properties? And what are things that you look for as an operator?
Well, the heavy lift ones that we were buying a few years ago don't exist right now, at least that I see in the major metropolitan areas. Can you hear me okay? Because I'm at a coffee shop, just making sure. Okay. So the challenge is, I'll go back on the ones that we had the most fun with. We had a 32 unit in Tucson. I don't remember the numbers. We bought it for 800. We bought it for yeah, I do remember some of those numbers. We bought it for 800, vacated all but 4 of the units and repositioned it. We sold it for 3.2. We put about $1 million into it. That was a really good one. And then, so the other one we did that was similar was a 74 unit. We came down to 17 occupied units out of 74. And the reason I share those very heavy lift, you go through what's called a valley of death, where you have nothing but expenses, you have zero income, or you have, a little bit of income, but it doesn't even cover the management. So the thing to be, when you're working with the investors, make sure that there's a period there where you got like a sinkhole of money. The money's just flowing out of the account and there's nothing coming in. And that scares a lot of investors. So it has to be a certain personality of investor that's interested in being a value add. But that's probably the scariest time for the investors. And that's exciting for us because that's when we see the changes going on in the properties.
Yeah, and I think you brought up a really good point there, Bruce. Like it requires a certain type of investor. And I think that's something to realize. I don't have them up here anymore, but whatever type of investment you decide to go into as an operator or even as a passive investor, you got to make sure it matches, right? If you want to invest in a core plus type of asset, but the operator that you're connecting with spends all their time in value add and opportunistic, then that's something to be aware of. You want to make sure you're working with someone that's operating in that space that you want to invest in. And same thing, just because somebody's excelling in a core plus asset and they see this opportunity deal, this heavy distress deal, if that's the first deal they're getting involved in, or they're not partnering with someone that has experience there, that's a red flag. And that's something you want to look out for. So it's not that you can't go into these opportunity or value add deals if you're operating at the core plus, but make sure the operations team and who you're connecting with either A, has experience themselves, or B, they're partnering with people that do have experience in that space, because that's going to mitigate a lot of the risk and make sure that things are flowing smoothly. And what are you looking for as an investor? If you're looking for consistent cash flow, you might be looking more, even if it's a little on the lower end, but you want that consistency and that stabilization, you might be looking at core or core plus. If you're not so concerned about the cash flow and want to capitalize on the upside and get some equity boost when that property sells, then maybe value add or opportunistic might be a better fit for you. So again, these are things that as investors, you want to know and you need to know, and to make sure that your alignment is aligned with the operators that you're partnering with and vice versa. And if it's not there, then you shouldn't be getting involved in that deal. And listen, go ahead, Bruce.
I'll just say something on that. The terms have changed. When I first got in this business, I've been in real estate since 2002, and value add was what's opportunistic now. That's what we had: value add and heavy lift. We had heavy lift, value add, and cash flow. Those are the 3 areas. Then they came out with value add was raising the rents, And to me, I call that doing your job. So that's not a value add. A value add is when you actually create value, like you did with your property, where you showed, like sometimes you won't even do all the units. And that's one thing we had learned along the way, which I'll get to in a moment. But our three largest projects were considered opportunistic. One was 22 units vacant in Glendale. I think Kyle Mitchell owns that one now. Glen Isle, we repositioned that. That was scheduled for demolition by the city. And the owner was in prison. So it was a really interesting purchase, but that was our biggest value add. And then the 7-4 on Stone, and then Vicinity Catalina and Tucson. But those were considered heavy lift, and now they're considered opportunistic. And so we're moving into real true value add from opportunistic for two reasons. Not number one is debt, especially bridge debt, is extremely expensive right now. We're looking at double-digit bridge debt where, that's tough. If you get heavy value add, you're looking at 14, 16% debt now, and that stuff. Investors are scared of it, right? So we're getting away from that and going into cash flow. We're part of the cash flow group. So cash flow day one and just doing a normal value add. Frankly, they're kind of boring, but investors like boring because they get paychecks every month and they're excited about that. So as the terms, and this will change every cycle, seems to have their own terms that come in. So I don't even use the terms core and core plus because we don't do anything in A and B. Everything we do is C, workforce, and the permanent residents, what I call people that are always renters, lower middle class, upper lower class, self-paying residents is our hyper focus. And we're still seeing some good opportunities in there, but we are making that shift. I know the terms change all the time. It's like every generation needs new terms to, like we used to call it workforce. Oh no, working class. Oh no, you can't call it that. Workforce housing. Now what did they have another name for it now? It's now I forget, but the government's always using new names because a name becomes offensive, I guess, if you use it too much, if you find people. Right?
Yeah, you brought us some excellent points, Bruce. Things change all the time, and operators pivot as well. So just because you're working with one operator and in a certain type of investment doesn't mean that that's going to be the one that they remain with. So if they pivot and it no longer aligns with what you're looking for, then make sure you're aware of that. And he brought up another good point is lending opportunities. There's going to be with core plus, value add, and opportunistic. It's not that there's not products out there for each one of those, but it's different. And what you can borrow, what you can finance, what you can get lending on plays such a major role into how these properties perform and knowing how you can leverage that effectively. So again, just things that you want to be aware of as investors. So well, that's all I got for you folks. Again, I appreciate you coming in and joining us for especially this week after the holidays and going into the new year. So what I want to challenge and invite all of you to do that have joined us either live or on our webinar here is start 2023 out strong. Have your goals, have clarity, know what it is that you want as an investor, and then start connecting with the right types of operators. And listen, I'm happy to connect you with people. I understand that what we do at Rev isn't a good fit for all the people that we connect with. So I'm happy to jump on a call, talk through with you what it is that you're looking for, and recommend you or introduce you to people that we know in our network that might be a better fit for you. So feel free to reach out, send me a message. You can go to investwithrev.com and schedule a quick discovery call. And I'm happy to do that complimentary for anyone looking to get some more information. So other than that,
Dallin,
folks,
I got a huge shout out to Dallin. There's two guys that he introduced me to that are doing heavy value add. And the one guy I'm not going to be able to work with, that one in Oklahoma, is just not a deal for us. But I've got some people I'm going to refer to the fellow out of Michigan. So Dallin does, if he has something that's a match for you, he will reach out. He's done it more than once. So he's an incredible networker. So if you need help, ask him, he'll help. And if he has a referral, he'll send it. So thank you so much for thinking of me on it. That was really powerful to talk to those two people. It was a lot of fun because they seem that the one in Oklahoma, I uncovered some things in the conversation that he didn't even think to ask about. which kind of made him nervous. And I said, I'm not here to scare you. These are things that can be scary. And if you have the answer, it's no longer scary. Where he said, well, I don't have an answer. So he's probably not going to do that deal, but I helped him come to that and uncover that for him. And you uncover it not to scare them, but to know if you uncover something, how are you going to handle it? And if you have the ability to handle it, then it's not a problem, right? So thank you for those referrals. That was both those guys. I think on a long-term relationships with. It's really cool.
Yeah, happy to do that, Bruce. So listen, at the end of the day, this game it's a team sport, and we're all in it to help each other win. So that's why we're very passionate about doing these webinars, giving back, doing live events to educate people, and just expanding everybody's network so they can experience a 1 + 1 = 3 type of situation, and that can really be accomplished. So appreciate you all for jumping on, and keep an eye out for our webinar next week, and let's go into this year nice and strong. And thank you for taking time to join us this morning. Take care, everyone.